All right, good afternoon, and thank you for joining the Energy Market Update. A special welcome to all of our channel partners able to attend today, and also happy opening day for baseball. That's me on the left, John Vieira. We have our trusty legal disclaimer on the right, and we'll be following the normal agenda of natural gas fundamentals, market news, weather, and then close out with market data to see where prices have been going. So starting off with natural gas fundamentals, as the spring has started, this has kind of become a non-story for the very short term. But our clients' terms go a lot longer than just a couple months. So this is already becoming important for winter 24-25 for possible outcomes. So last week we actually had the first injection of the season. So injections have started, but this weekend having another withdrawal. So that's why the number's in red. So being negative. It will be flipping back and forth maybe a couple times over the next several weeks, and then it will turn into complete injections until we get to later next fall into the winter. So we had estimates for 27 to 29 being pulled out of the ground, and we actually pulled out 36. So slightly bullish on today. Some rumblings, some prices moving up a touch after the release came out today. The biggest story, though, is right now, compared to last year, and more importantly, where we are compared to the 5-year average, we are swimming in storage right now. So 669 billion cubic feet above the 5-year average, where just a couple months ago, we were starting to get close to breaking it down into the only having a double-digit cushion above that 5-year average. And we were worrying how we were going to get through the rest of winter. Well, this winter ended up being one of the warmest, if not warmest on record. So that demand really didn't come through, even though there was a couple of late storms that just hit and lingering cold weather. So for right now, the natural gas story is, very bearish. Nothing's happening. But more importantly is what is this going to have people do to react? So it really gets into gas producers. If they're not making any money producing and having to put it into storage and using it, and the price has been low, they start not renewing leases. They ramp back on production. So this could be, as we move forward through the spring into the summer, and we start getting possibly moving from a El Nino pattern to a La Nina pattern for weather, meaning basically warmer to colder, we could be walking into finally a cold winter come next 2025, and the production went down, and all of a sudden this becomes a big story 5 to 6 months from now. So something to keep an eye on, but for right now, we got plenty of storage and gas, which has helped keep a lid on prices, especially with all the other bullish fundamental stories going on. So just take a look at that on the graph. We see the green arrow over on the right pointing to the blue line. That's where we currently are. The gray shaded area is the min and max, and the dark gray line being the average. So we're well above that right now. But again, these things can change quickly. Just looking back on the line, we were well below just a couple of years ago, and we went to well above. And that's what we're going to be following through the spring, summer, and into the fall. Early market estimates for next week are calling for withdrawal in the 33 to 43 range right now for week ending March 29th. Other than that, we know the story of production here in the US, the possible ramping down. We can kind of see the gold line up top going into the forecast for the gray box. Not really moving up, possibly moving down a little bit, where demand actually moved up for that magenta line since the last time we talked. So this being an updated picture. And the LNG story continues. We continue to put more gas out from our shores, so less gas here to other parts of the world means less supply for the US. And these numbers only looking to grow. And most forecasts having them doubling or even more from 14 and change to 28, 30 BCF going out the door in just the next several years. So one story that kind of had everyone talking just a while ago was Department of Energy Secretary Jennifer Graham. They initially put a pause on several LNG projects. Well, she just came out and said it is only a pause. It's only going to last several months, maybe 6 months, possibly a year, but we are not stopping the LNG train. So that was kind of surprising news coming from her, because she's really usually against all things fossil fuel. But to hear that these LNG projects are going to continue means that more gas will be leaving here for less supply. And where is it going? The national balancing point for the UK, the title transfer facility price for the EU, and the JKM, the Japan Korean marker. And lately the JKM has been moving up, so actually more gas might be heading towards Asia as well. For the channel partners on the line, this is the updated confidence interval. The arrows on both sides might look a touch bigger, but that's because on the new graph, the number 12 from the y-axis on the left disappeared, so it just looks bigger. But in relation, not too much of a change from the February forecast to the March forecast. Still much more of a risk that prices go a lot higher, especially the further we move out, versus a lower chance of those slipping off. And this is the idea that we want to be applying to our regional graphs, whether it's the multi-year line graph or even just Cal 25 or Balance at 24. Taking a look at market news, this is something we covered last week, but just to rehash it quickly for our channel partners on the line, huge news coming out of the federal level with both President Biden and the EPA rolling out an announcement for finalized rules of forcing EVs from 2027 through 2032, where almost 70% of sales are going to have to be hybrid or electric by 2032. So that's a huge amount, driving up demand. There's a lot of questions about whether this stays in place, whether it was even legal for the EPA to do it, whether Congress will overturn it, and what comes next presidential election. Because if candidate Trump wins, he said he's going to peel this back day one. President Biden wins, he said he's probably going to even try to go further on this, because this was option C. It was not as aggressive as they hoped to get it. So they wanted to go above that 70%, maybe 80, 90% of cars going electric, like we see with some of the rules coming out of California that we're going to touch in a second. Our takeaway really is that EVs are going to drive up demand on the grid. This is happening at the same time that we're electrifying everything. So demand continues to go up while fossil fuels are trying to be shut down. So really recipe for prices going up for those outside years. So yes, we might just be coming off 52-week lows for a lot of our major markets from mid to late February. But that's only for maybe the next couple months, and possibly, I mean, the next 2 to 3 years of your term really could go up, especially if the energy landscape is going to change this much. Now, in past calls, we've talked a lot about bans and rules being put in place to force green energy to come in and clean energy. One thing that is a really big story that is energy tangent, but really is going to drive up demand, is the AI revolution that's going on right now. So the NVIDIA CEO came on and said, you know, our chips are ready to go. They're going to change the way computers work and they function. Experts are really debating about, I mean, what the impact's going to be compared to a Google search. Using AI can be used 3 to 30 times the amount of electricity. There's going to need to be bigger data centers put everywhere to run the AI. The cloud platforms that we're currently functioning on are going to be replaced with AI platforms, which are very power hungry. And unlike a lot of these bans and rules being put in place saying use this, not that, everyone wants a faster and smarter computer. So the adoption of these, unless something, a barrier is put in the way through the government or state level, everyone's going to want these new devices, and that will also shoot up demand. So if this is happening with the electrification process, with the EVs being forced, and then everyone wanting to get a more powerful phone or computer, really could be in a totally different energy landscape in just the next couple of years. So taking advantage of looking at those outside years with clients now, especially when markets are in favorable positions for a lot of our markets, not for ERCOT, which we know getting closer at the 52-week highs. Taking a look at some news stories, the presidential budget for calendar year 25 is out now. A lot of the energy industry is upset because there's around over $110 billion in tax hikes against domestic oil, gas, and coal. So this is a huge amount of money that basically is getting taken out from the fossil fuel industry at a time when many things are shutting down because of all the different rules and lack of subsidies and or tax incentives that have been stripped away over the past couple of years. A group of Republican senators already have written to Treasury Secretary Yellen and basically said, you know, I mean, this is a weaponization of the tax code. I mean, that's an opinion, but basically being used to crush fossil fuel business. So this comes out just after a couple months ago, a Department of Energy report from the Biden administration came out saying that there's significantly, and this is a 59 long page report, that there's a significant amount of taxpayer support and money going towards clean energy when compared to fossil fuels, which goes against the reason that the Treasury Department did for pulling back these tax incentives. They said it was to create a neutral system, which seems to go against the DOE report released by the same administration. Either way, our real takeaway is that less support for fossil fuels will hurt our supply picture in the US. So taking actions to shut down reliable, resilient generation that we've had for years and has functioned while trying to replace it with new clean energy generation, which we've talked about the many troubles with the offshore wind projects coming online, and then demand growing from electrification, whether it's through bans or new technology, really, again, could be in a new place for the energy landscape in a couple of years. So taking advantage of those longer terms sooner than later. Speaking of one of the issues with bringing on clean energy, taking a look at solar. So a hailstorm in North Bend County, Texas, just knocked out basically an entire solar field. So Fighting Jay's Solar, basically a 350 megawatt solar array was taken out by a hailstorm. So one issue it brought up again was about the chemical leaks, because cadmium telluride, which is used in some of them, is very harmful to humans. Would that be an issue? How clean and green is this if it's releasing toxic chemicals? The more important question is really the function of the electric grid for resiliency and reliability, which usually is tested during storms and inclement weather. So if a generation source can't function if there's clouds or if there's inclement weather, that could be a big problem. So how much reliance or what percentage of the grid generation should come from something that if the sun doesn't shine, if the solar panels are damaged, should that be 50% of the grid and 50% wind? And then if you have bad weather, you can't run. It's a question that a lot of people have been trying to examine at the academic level. Headlines say a very different story, but that's something we need to keep an eye on. How fast do we make this change? Is it actually working? What happens if this storm had taken out 4 or 5 arrays? That would be a sizable loss and would cause a price spike, because 350 megawatts is comparable to a big natural gas generation unit. So these are a big impact. It's not like just losing a couple houses on your street worth of generation. So our takeaway really is that this one singular event is not going to affect ERCOT pricing. It's really calling into question the road that we're going down. If we're pushing wind, solar, clean energy without considerations for reliability and resiliency, it's basically will make the next coming years more volatile and more susceptible to price spikes during weather events, clouds, or lack of wind. Moving over to Maine for ICE New England. Maine just rejected an EV mandate, which was pretty much a mirror of California's EV mandate, which we just talked about the federal level coming in. California's EV mandate goes past and more aggressive than the federal. And if it had been enacted, at least 51% of new car purchases would have to be electric by 28, and 82% needed to be electric by 2032. So the Maine Board of Environmental Protection came out and rejected this and shot down the proposal from Governor Mills, who has been pursuing a very aggressive clean energy agenda since taking office. Maine has been a more purple state in years past, flipping from blue to red and back to blue. So interesting and important depending on what clients you're talking to, what type of state they are in. Blue, you can expect maybe more rules like that could be enacted to go more aggressive than the federal government. In a red state, you probably won't see this as often. So the reasons that the Board of Environmental Protection gave for rejecting the rule was that 84% of the people that made comments and votes on it from citizens and stakeholders were against it. They also said Maine's too rural for this idea to be able to work in the state, and also very worried about the cold weather. We had talked a few months ago about what happened out in Chicago with a lot of EV problems not being able to charge, and if they could, they were dying sooner than they expected. So our takeaway from the whole story is ICE New England's at least tapping the brakes on that future demand going straight through the roof, which is going to be pushed up by the federal rule that just was ruled out by the Biden administration and the EPA for going into EVs that starts in 2027. But we also need to be aware of other rules coming out in states that get floated. Make sure clients are aware before those rules pass, because that will definitely push up the outside year prices like we're going to see when we get to the market data. Take a look over at what's going on in Israel. We've talked about since the start of the war, supply issues, starting with the Tamar Energy Platform field being shut down. It has been restarted. The biggest issue right now that we were wondering if it was going to be an issue was the surrounding bodies of water for supply of goods around the world. So the Suez Canal has been having a lot of issues. So ships are being rerouted around the tip of Africa, showing that second picture next to the paragraph. So that's taking a whole lot longer for the round trip of these ships to make. So it's driving up the price of ships, LNG vessels, energy components. So it has a knock-on effect on prices, and that's the big story with all of these world stories is how is this going to affect the supply chain? Is it going to make life easier? Is it going to make things more difficult to get built, especially if we're making all these changes to our industry right now? And right now, one of the shipping giants is saying this is going to at least extend into the second half of 2024, if not longer. Bigger news is a UN security ceasefire just passed. So this was very interesting. This happened later on Monday after several ceasefire votes had failed to go through. It only passed because the US abstained, knowing that the other 14 were going to pass it. So this is a big break for US-Israel relations because we've always kind of had their back. The biggest piece of this that Israel's upset about is it was not a hostages must be released and then there will be a ceasefire. The resolution called for an immediate ceasefire, plus it also called that hostages be released but not tied to that action. It's also only a short-term ceasefire. The bigger thing is how does the relationship go with the US and Israel, and will they take our influence to maybe bring this to a resolution sooner than later, or are they going to be more emboldened to do what they set out to do initially? Because Israel just canceled a high-level delegation meeting with the US as a direct result of this vote. And we know that it's extended further into the Middle East, and that is what we're worried about, is how big of a world problem does this get? And we're also seeing the Israel, the Russia, Ukraine, and the China story kind of seem to come together, where China, Iran, Russia kind of teaming up on all these issues versus NATO, US, and the usual suspects. So taking a look over at Russia, Ukraine, wish I could say things seem to be getting better, but they don't. Putin is now saying, because floating the idea of bringing F-16s to the Ukraine, being donated from other countries, he's saying he's willing to attack them, whether they're in the Ukraine or if they're in Poland or France or wherever, but he's saying it's not going to be an act of war against those countries. He's just going to attack the planes. Now, the rest of the world might take it differently. As we talked about just a couple weeks ago, the Greek PM was almost hit by a missile when visiting the Ukraine front lines, which would have triggered Article 5 of the NATO, which would have basically put them on a war stance against Russia. On the other hand, we have NATO considering shooting down Russian missiles, which again would be an escalation of the conflict, which has been to this point mostly a proxy war, because recently some missiles have flown over Poland, and on their way to the Ukraine, they've entered Polish airspace. So that would be an escalation. If that happens, it's not a definite thing, but hopefully these things don't happen, but they are out there, and that could immediately cause much bigger supply chain issues than we have seen so far. And lastly, just in kind of a way, I think, to needle the US, Russia is extending the sentence of the Wall Street Journal reporter. So again, not a chance to kind of an olive branch, maybe make some closer relations, deciding to keep him there. So the US is not happy about that publicly. Taking a look at China, big story, we're waiting to see what happens in June for the solar waiver that was put in place, because basically 4 Southeast Asian countries were importing solar panels that were made in China and they rubber stamped them. Again, China keeps coming up a lot because right now they control a huge portion of the world's critical minerals and even more of the processing of those minerals. So they're very critical in how everything moves forward. And that brings to a head what they're bringing as a complaint to the World Trade Organization against the US. So right now, the US has put in some rules that basically if a company is so much controlled by China or influenced by the Chinese party, even if it's not the country of China, they can't get any of our subsidies from taxpayer money for these EVs. We talked about a couple weeks ago, South Korea asking to ease some of these restrictions because they can't make their EVs without the Chinese parts. So coming to the World Trade Organization, China has a pretty good argument from if you're being objective about what the subsidies go. So again, shows the relationship fraying more at a time where we're forcing the country down a road that's going to make us depend on China, where, I mean, we simply don't have the processing ability or the minerals in hand right now. And that also has caused other things with the trade war. So in August, they stopped selling some materials to the rest of the world because of the fight around computer chips that continues to grow in the AI fight. And then we also have in December, the beginning of December, some products related to EVs, which if it was just EVs not coming on the road would be slightly bearish, but it's all the other generation sources. So late in December, they were talking about canceling technology for wind plants. So again, that would be very bullish if we're not able to build wind. There are other places in the world, but again, it's not helping the world supply of moving towards here without China. For our fuel sources, updated picture, not much of a change. The two red arrows for actual generation coming from renewables for solar and wind, not going straight up, slight increases maybe into the future for short term. And then we have an updated slide here. So this is 2023 Q4 results. And BPA, just to discount that quick, it's all the way to the left on the boxes. And right here, they have natural hydro that they've had for years. So it's not like they just installed this. They just were always naturally this renewable up in that corner of the country. Just lucky to be there. But most of all of our major markets, PJM, NYISO, ICE New England, not a huge amount of actual renewables, and even less, of the actual wind and solar. And if we look year over year for these numbers, PJM slightly down, NYISO slightly up, ICE New England slightly down. So not making jumps of 5, 10, 15% renewables currently. So we are well off track from what a lot of the projections were. Taking a look, we also want to talk about the other components. So for capacity pass-through still being a good option for PJM and ICE New England, especially with all the changes to the market. Since the new rules and subsidized assets for clean energy and demand response have been put in, since the below the yellow line, prices have continued to come down, expected to stay lower for most all areas of PJM. The next auction was canceled from this past June, just days before. And it's for this coming June 12th. So expecting that to maybe run this June 12th or if more rules are laid out. But again, that will add risk premium on if you're locking in the capacity. But if a lot of the studies and analysis say this should keep a lid or bring prices down, if a client locks it in, supplier keeps that money. And also if the supplier improves the capacity tag with peak notification, which that program is going to be starting soon and is free, they won't get any of that benefit. Same story for ICE in New England with whether the price goes down at the market side or people are able to manage their cap tag through peak notifications. The FCA 18 just came out slightly higher for all zones, but within where the bandwidth would be for risk premium, nothing like we've seen in past years where it spiked. Other two news for ICE New England is that the FCA 19 that's supposed to run Feb 2025 has been pushed to Feb 2026. And also ICE in New England might be looking at totally redesigning the capacity market. And they might have a vote on it shortly. Still kind of unknown. They only released this recently. Taking a look at weather. So this is the March release of April to June forecast. Around the Great Lakes, leaning likely above. So we might see some of that heat coming through as we get to later spring into early summer. In Texas, starts at going above, especially in West Texas. And then if we take a look at, say, March release from May to July, Texas looks like it's getting real hot. And some of that heat for the Great Lakes might be pushing further over into ICE New England, especially for short term. There's a path for that heat to come across to us and really heat up PJM, NYISO, and ICE New England. One interesting story to keep an eye on is where the weather pattern goes from here. So we went through this past winter with El Nino. We didn't have as much Arctic blocking to cause as many storms. So again, we had a very warm winter, maybe one of the warmest, if not warmest winters. But El Nino conditions are declining, and we're kind of moving towards going to possibly neutral by mid to late summer, and possibly entering La Nina by the end of the summer into the late fall. So we could be going from having a very hot summer to a very cold winter finally for the Northeast Mid-Atlantic regions. So something to keep an eye on, especially with the gas stories. Everyone feels comfortable now, but in a couple months, this could change very rapidly, and we might be in a very different price environment. Lastly, for weather, it is spring. No freezing temperatures across the board, and nothing really popping into the 90s down in Texas. So for right now, it's kind of that holding pattern. That's why shoulder season is what it is, and usually sometimes the prices come down. We had the warm winter, and now, I mean, nothing crazy with temperatures, so we kind of have that pause on prices. Just don't wait too long. Taking a look at market data, ICE in New England, we've been seeing the summer move around and the winter months for balance of the year. So balance of the year is now May to December because April came off the board. So May to December is going, and most client contracts are only going to have part of April in there. So again, May to December is the balance of the year. So looking at calendar year 24, ICE in New England was pretty flat week to week. And when I say pretty flat, that means below a quarter mil difference Wednesday to Wednesday, or below a quarter cent change for gas. But again, we take a look at mid to late February, a lot of these prices are coming off those lows, moving up, kind of in a higher price environment, waiting for a reason to move further. ICE in New England calendar year 25 was off a half a mil week to week, but again, it's kind of been making a run lately, getting closer to that midpoint between the average and low versus being at the low. Taking a look at Algonquin gas balance of the year, May to December, off 1.5 cents week to week. So this is the one gas that really hasn't made that move too much up from the low. But this also is kind of because the y-axis, it had a bigger change that way. And Algonquin 25, similar story, off a half cent week to week, still near that 52-week low. Moving over to PJM, same thing. The summer months, trying to figure out how that heat's going to come in. And the winter months, hey, is that La Nina going to come around and really cause a cold winter? We could see those jump up. And we've been seeing those fluctuate week to week on those reports. So PJM balance of the year, May to December, pretty flat week to week. So again, less than a quarter mil of movement. And it's hanging out just below that 52-week average. So this is what first happened in ERCOT, I mean, with the heat coming through, and they're at 52-week highs. PJM starting to push the 52-week average. Good chance to lock in while you're still below, because again, the old highs are going to disappear, and it's going to move the averages around at least for 52 weeks. So also make sure to use your long-term chart to show how high and low things can go. But again, COVID, we're out of COVID. We have a new administration rules, and the clean and green energy movement isn't going to necessarily just stop. It only might either slow or go even faster depending on the next presidential election. Taking a look at PJM calendar year 25, off a half mil week to week, still a little bit above that 52-week average. So again, and we're going to see PJM has a bigger story on this. PJM is very worried about losing the coal, which makes up a significant portion of their generation, an issue that ICE New England doesn't have to worry about, but Texas also has to keep an eye on. So when we take a look at the long-term chart, you're going to see 26 and 27 a lot higher for PJM. Taking a look at PJM gas, off a penny and a half week to week, still closer to the 52-week low after making a run at that midpoint between the low and average. Calendar year 24 for PJM gas using TETCO M3, off a half cent week to week, still a little closer to that 52-week low, but again, moving up from that mid to late February dip for now. And taking a look at ERCOT, summer definitely coming into focus as some of the forecasts are showing possibly warmer. We had record-breaking demand on ERCOT last year. Could we go past that again this year? Economy's been doing well. It's getting hotter, and there's been more build-out going on down there. So ERCOT, Houston, balance of the year. Made a run at the high recently. Kind of hanging around. It's been kind of going up and down like a whipsaw. Has a chance to take a dip, get in on that. And taking a look at ERCOT calendar year 25 using Houston load zone. just hitting a 52-week high on Tuesday. So again, those prices are moving up. It's not to say that they can't go higher, because that's when you kind of look at the long-term graph. They were here just not long ago. And before this point was really just a totally different world, before all these global issues happened and new administration took over from federal level and state level rules that are being put in place for the clean energy change and all the issues that are not yet been resolved. Taking a look at Houston Ship Channel balance of the year, off 1 cent week to week, still close to the 52-week low, but higher than it's been. And Houston Ship Channel calendar year 25, again, off that last dip, moving a little bit higher, kind of in a holding pattern, especially if you look at the short term, a lot of these, right? Not too much of a change going across. Henry Hub and Houston Ship Channel, we know very similar shapes. But as we go around the different areas, we see kind of a different story going on. We're seeing the basis kind of get closer for Algonquin, kind of as it's dropped. So definitely highlighting a good time to lock in that basis for Algonquin. On the other side, the PGM being below, which after it gets weighted for your client's usage usually comes out as a positive basis, it's starting to lose that advantage that just had a little while ago. And just zooming in on that, we can see the spacing, being further apart, almost 2 lines between it, and now it's only 1 line between it for the gray to red. Taking a look going out into future years, 25 was off a half mil, but the opposite for the outside years, 26 to 28 were up a mil and a half, 29 to 32 were up around a half to a mil. And as we go to the outside years, these are the charts that might be a really easy way to say, okay, when was your last contract? Well, you bought here at this rate, and currently we're up here, to help explain, how wholesale impacts their prices besides the other components that they have for the specific region. But just being able to help tell that story and then showing where prices can go. So we're not going back to the old world of fossil fuel being supported completely. We have world issues going on. So maybe this being like a lower point underneath, and whether you use where 24 went or top of 25, you can clearly see the amount up here to here or here to here is a lot bigger than just here to here. And drawing those arrows, whether doing it online or in person, really seems to stand out with clients. Taking a look at PGM, 25 off a half mil. Outer years, again, all up around a half mil. So kind of what's in front of us coming down a little bit, but a lot of these other stories that we're talking that are going to be coming into play, continuing to push up those outside years. And here's the comment I made earlier about those outside years and maybe that worry of coal going on. We see 26 and 27, a good amount above where 25 is right now. So again, people at this time of year are going to be seeing summer rates really low for ICE in New England, PGM, NYISO. And that's because those months are very low compared to the winter months when they're not there. So very important when talking about terms and those future years being higher, taking advantage sooner than later. Lastly, taking a look at ERCOT, trading much more tightly together, pretty much on top of each other. 25 was pretty flat. Outer years were flat to slightly up. And we can see that with pretty much all of the lines overlapping for those outside years, 25, 26, 27, making the push up. But they could easily get higher, so it doesn't mean it's not a bad time to lock in before that summer heat gets here. In conclusion, a lot of our main points not really changing, but I want to start with the top right, really. ERCOT Electric hitting 52-week highs, could go a lot higher. All of our other major markets except Algonquin for ICE and oil and gas have pretty much moved off those mid to late February 52-week lows. So the chance to option to lock in below those 52-week averages might not be here for long. Yes, right now, very cool, maybe a month, 2, 3 on price volatility, but that could be changing very soon, and especially those outside years looking for longer term. And that's what we want to do, help explain managing risks, evaluating the longer terms because of where the markets are and where they could be with demand going, possibly skyrocketing through the roof with all the electrification going on, the EVs, plus AI revolution that's happening. And for the ICE New England, PGM, ISO clients, very important to explain short-term utility rates for the summer against a 12-month contract, because all the most expensive months aren't part of that price, and they might be losing out on value, especially for those future years if they don't make a decision. Other than that, really the price components, talking about capacity, the renewables, how to optimize those, always help try to show the full picture to a client. Thank you everyone for attending. For our channel partners, please reach out to your account manager